Right, a company administration, or admin for short, may save a limited company. It can help keep people's jobs and even in most cases allow the directors to start again debt-free. Now, most directors, they do not even think this is possible. So watch on, and I'm going to share with you all the secrets about the insolvency process, company administration. I'm going to be sharing the following things, so please watch to the end. What is administration? Why does a business go into administration? How can a director legally buy back the business from the administrator and start again debt-free? What the differences are between liquidation and administration? What are the benefits to administration? And to give a little bit of balance, what are the drawbacks? And then I'm going to finish on a real life example of how an administration saved 80 jobs. So let's start at the start. First of all, you can go into administration if you've become insolvent. Remember guys, the corporate insolvency test is 3 tests. The first thing is the cash flow test. If your business can't pay its debts as and when they fall due, it's insolvent on a cash flow basis. So if you've got a time to pay arrangement, you're behind with your CBILS, behind with your recovery loan, behind with suppliers, it's a clear sign you're insolvent. Number 2 is the balance sheet test. So you look at if your liabilities are more than your assets, you're also insolvent on a balance sheet basis. There's another thing called the legal action test, and that means if you've got a CCJ against the company, it's not been paid off, you're insolvent. If there is a stat demand been served on your company, you're insolvent. And to the nth degree, if a winding up petition is served on your business, it also shows that your business is clearly insolvent. So if you're insolvent, one of the options would be company administration. Now, the definition of an administration, it's a legal process where an insolvent business is placed under the control of a licensed insolvency practitioner, and it's designed to protect that company from the creditors, the people that it owes money, and hopefully rescue the business. Now, the purpose of an administration is to either save the company or sell off the company's assets and provide a better return for the creditors than a straightforward liquidation. Now, why does a company go into administration? Well, obviously, firstly, the business has become insolvent, but it could be 1,000,001 reasons. You know, cash flow difficulties. Maybe they've not been paid for a job that they've done, which has caused difficulties paying everyone else further down the chain. There could be some type of legal action that's pending. You know, the threat of a winding up petition could be like the final straw that breaks the camel's back, and a director seeks insolvency advice. It could be that they're essentially just too much month at the end of the money. They're getting further and further behind the 8 ball when it comes to paying the debts on time. Now, reason for an administration could be a rescue attempt. You know, if the aim is to save the company as a growing concern, or at least the business, an administration could do that. Now, I'm going to talk about the administration process, okay? There's a number of steps to administration, but the first one is initiation. The directors or the secured lenders of a company appoint an administrator through a court process. So if it's a director-led appointment, what you really need to do is make sure that before you appoint the administrator, you get an agent on board, and you get an agent on board to value your business, okay? And that should sort of give the director an idea of what this business may be worth, and what if they're considering buying this business back out of admin, which I'm going to come to a little bit later. Now, once you've approached an insolvency firm, they'll either file a notice of intention at court or a notice of appointment. It's done within a couple of hours. You might have to swear something at a local solicitor's office. But once that has been filed at court, there's a control shift. The appointed administrator takes over the management from the director, but they're going to work with the director, but there is a control shift at that notice of appointment stage. Then there is a moratorium period, and this is what directors want. The moratorium period is a temporary halt on legal action against the company. It provides them a little bit of breathing space. Now, while all this is going on, there is a marketing period carried out by the agent, and this is where offers are invited for that business, okay? This is the bit that worries directors, but listen on, and I'm going to hopefully allay some of your fears. And at the end of the marketing period, offers are invited to buy the business. The winning offer gets accepted, it gets handed over to a solicitor, and there's a sale and purchase agreement done. The administration is ended, and the business, in most cases, is bought out of administration. And let's talk about that, right? Because I know a lot of directors, what they want to do is pre-pack. They've heard this term, what's a pre-pack? Well, a pre-pack administration is where the directors of the insolvent company set up a new company or already have a connected company, and they buy that business from the administrator out of administration. Now, you can do that. You can buy all the assets of a company, including things like fixed assets, tables, chairs, vehicles, plant machinery, intangible assets such as website, phone numbers, database, work in progress, even debtors, a debtor's ledger, so money that's owed into your company in certain circumstances, you can buy that from the administrator. But if you're going to look at a pre-pack, it's really important that you get this valuation done by an agent. Now, normally your insolvency firm will help guide you with a number of agents who they can use. And what they'll do is they'll come and give you a valuation, normally before you appoint the administrator. Okay, the difference between in situ and ex situ is really important for you to understand. So I'm going to talk to you about what in situ means. And in situ means basically is when assets will stay in the same place. Their in situ valuation is typically higher than an ex situ valuation because it has the added value for a business that the assets are being ready for use from the current trading address. Basically, nothing's changing without the need for relocation or reinstallation. Now, ex situ is contrary to in situ. It basically means what would those assets of the business be worth off-site or essentially out of place. Valuations done on an ex situ basis consider the value of the assets independent of the current installation context, okay? So this approach evaluates the assets if they were to be sold separately from their current location. So separately at an auction, so you're going to have to consider agents' costs, relocation, decommissioning costs, auctioneers' fees, and this figure is generally a lot less than the in situ figure. Now, if you're looking at doing a pre-pack administration, you want to buy the business out of admin, you're going to need to make an offer and hope that it's the winning offer between these two values to the agent at the end of the marketing period. Now, the closer that you could offer to the in situ value, the harder they're going to find it to turn down your offer, okay? Now, I'm going to explain to you now the difference between liquidation and administration, because they're two different processes. The purpose of an administration is to achieve a better result for creditors than a liquidation. Now, a liquidation and an administration, although they're both formal insolvency procedures, they're in fact very different processes which ultimately look to achieve very different outcomes. In simple terms, a liquidation brings about the end of a company. It's basically it's the end of the line. If there are some assets, they can be sold for the realization of creditors before it's dissolved entirely. Whereas an administration, on the other hand, it's typically utilised when there's a chance of saving a business, which currently it's experiencing high levels of financial or operational distress. So let's explore that a little bit further. Liquidation is employed when a company's beyond rescue. It's done. There's no silver lining. It's the end of the road. The directors no longer want to continue. Okay, there's sort of two two sort of liquidations that can happen depending on the state of the financial situation. They can do a voluntary liquidation or they can do a compulsory liquidation. But because this video is on admin, I'm going to get to that point. One of the biggest worries that a director has when it comes to an administration, excuse me, these longer videos do take it out of my voice. The worries about a director has, the number one worry when it comes to admin is about losing the company. Because once you go into administration, there's a marketing period and your business is marketed by the agent to potential buyers. Now, what I've been involved in lots of these over the years. These adverts, these marketing periods, it's not like saying Director First Insolvency is up for sale and emailing me all my competitors. What they generally do, it's an advert, it's a fairly general advert, so they don't know who you are, and they send it to their database. Now, I have been involved with a lot of these over the years, and I've never seen it once bought by a competitor. And I think the main thing is these marketing periods can be concluded in 5 days. And there's very, very few businesses that will buy another business on 5 days due diligence. So I want directors who are considering to do this. It's highly likely, and in my case, I've never seen it, where they lose to a competitor. And it's worth putting in this video as well is, even through the marketing period, a director has the option to withdraw. They can go, I actually don't want to go through with this. So just a bit of comfort for those directors out there. Now, there's a number of benefits to an administration. Now, first things first is legal protection from creditors. You get that moratorium. An administration offers a moratorium, which is a wall of protection against all legal action that's happening against the company. So when you're in administration, creditors can't continue lawsuits, they can't present winding up petition, they can't send bailiffs to the door. And as a result of that, there's a protection of the company assets, because the moratorium also helps protect the company's assets from being seized by creditors. So it gives the administrator a little bit more time needed to sort of reorganise or sell some of those assets. In administration, there's always the opportunity for the business being rescued or restructured. Maybe as a going concern, they might look at something like a CVA, they can look at renegotiating contracts, but there's a good chance that this business could be rescued or reorganised. And obviously another benefit of admin is you continue trading. Under an admin, the company continues to trade. It can help preserve jobs, it can potentially improve the company's financial position. And what's important to understand here, one of the main benefits of admin is it maximises creditor returns. Administrations often result in better returns being paid to creditors than liquidation. And the simple reason is an administrator can make strategic decisions about the asset sales and the business operations. Another benefit of admin is it's a controlled environment, controlled disposal. The administrator oversees a controlled sale of the company's assets for the best value. Again, it gets the best return to the creditors. So another thing that's a benefit is there's a number of potential exit strategies. A director could go into admin and then perhaps look at going into a company voluntary arrangement, CVA. They're suitable for businesses that have got a really good chance of being profitable going forward, but they are just getting pulled down by legacy debt. It's a short-term problem, and a CVA allows you to put all your unsecured creditors into one pot and pay them over a period of time, normally 5 years, but it can be 2 years, 3 years. And again, the admin gives the protection, and then you exit into a CVA. CVA is not for everybody. What a lot of companies that will go into admin will do, will go into admin and then actually pre-pack the business out of admin. So they're starting the business again without the legacy debts. I've got to go through some of the drawbacks to administration, because it's not all sunshine and lollipops. Placing a business into administration, it can have several drawbacks. The first one is there's some loss of control. Once a company enters admin, the control of the company is passed to the administrator. Your decision-making powers has stopped while that's happening. You're going to have to liaise with the administrator, but you, the director, are no longer in the hot seat. There's obviously public knowledge. When a company is in administration, people know about it, your creditors know about it, it's a public affair. So reputationally and from a PR point of view, it might not be good for people seeing that you're in administration. Another downside is potentially your business could be bought by a competitor out of administration. It doesn't happen very often, but to say that it never happens would be untrue. It is a risk. And obviously the financial implications. There are costs. An administration process can be very, very expensive. The fees for the administrator, there's legal costs, there's agent costs, and they can all diminish the funds available for creditors. So there's also some legal and compliance issues that we've got to talk about. If you go into administration, there's going to be a director's conduct report. An administrator is going to review how you've behaved as a director. They're going to look at things such as wrongful trading. They're going to look to see if there's any overdrawn directors' loan accounts. They're going to look to see if there's any misfeasance claims that can be aimed at you, the director. All these things can't be avoided. Once you go into administration, it's the administrator's duty to look for things. If they find any problems, they're going to raise them with the director, and that potentially is going to cause you more personal expense. Remember, it's really, really important to have a look at these things before you start any administration process. And come on, we've got to talk about this, the emotional and psychological impact of such a procedure. This is going to be stressful for you. There's going to be overwhelm. The prospect of losing control of your business, something that you fought, for many years for, probably, it's your baby. That's going to take its toll on you. To think you're going to go through this with not a care in the word. I see it. My job is to hold the hand of the director. And the only thing I can say to you, if you're thinking about going through this, or you are going through this, you've got to have someone next to you guiding you and protecting your interests. I'm going to finish up now to actually discuss an admin. So, last year we was approached by a company. They were £3 million in debt. They had 80 staff. They were struggling to make payroll, and there was a threat of a winding up petition from the HMRC. And I'm going to give you a bit of context. This company had offered to pay HMRC over 2.5 years, and HMRC just took the decision that they weren't going to accept it. And it was when the threat of a winding up petition come, there was a referral from someone I've worked with before. So we got the call. When we dug into it, there was a number of contracts that were losing money. Material and labour had gone up. They'd agreed to a number of fixed price contracts. Obviously, they agreed to that before the world went silly and everything went through the roof. The straw that broke the camel's back was the threat of the winding up petition from the HMRC. So first things first, we got engaged with this company and we spoke to HMRC, and we just said, listen, give us 4 weeks. We're going to review things. We're going to come back to you. And they agreed. They just stopped action for a period of time till they heard from us next. Straight away, we got an agent down there. An agent valued all the assets, the equity in the vans, the plant, the machinery. They also reviewed the debtor's ledger. Remember, a debtor's ledger is money that's owed into your company. Now, in line with this, any new company was going to need some financing, so we assisted in finding them the right factoring deal for the new company. And what actually happened is the factoring company come in and replaced the current factoring company and lifted them out. We also looked at refinancing all the vans for them, so they could get the vans from this company, quite a few vans, into a new company. Quite a lot of work was going on behind the scenes. Now, we then needed to really dig deep into what was going on. What were the financials of this business? You know, what had gone so drastically wrong that a business that had been going for 30 years, who were busy, this firm was busy, they had loads of lads out there, everybody knew them, but they were close to being running out of money and being wound up. We've got to look at what needs to change in the new company to ensure this doesn't happen again. And the reason were fairly simple. They couldn't make money on these jobs that they had entered into, these fixed price jobs they committed to, due to a huge increase in labour, costs, materials and supply chain issues. And in addition, the turnover had fell from 7 million to 5 million. So when this happened, the directors went out there to try and get more work. But sadly, they took on work that they perhaps shouldn't have took on. You know, the right level of due diligence wasn't done there, and these contracts lost money. So when we looked at it, is if none of this stuff had happened, if they could get rid of some of this legacy debt, could this business survive and thrive in a new company? And the answer was yes. So but by looking at these numbers, what we did is we put together a cash flow. We was also the company, should the business be bought out of admin, we believe that the new co would be viable as long as there was some funding in place, and importantly, the customers would allow them to novate the contracts into the new company. So after speaking to all the customers, which the director did, they wanted to keep the customers agreed to work with them in the new company. And if you're worried about that, as long as you're doing a good job, it's highly likely your customers are going to want to work with you again, okay? So that was one big job out of the way. A new company had all this contract work to go in, it had all the vans in place, it had a new factoring deal, so everything was looking fairly rosy. We had to also check the bank statements. Like we literally said to the director, just hold your horses. What we've got to do here, we've got to look for any implications to you. Really, really important. So we reviewed the bank statements to check to see if there's any action against the director once they were in admin. You've got to remember, an insolvency practitioner is going to look at how the business has become insolvent. And if there's any wrongdoing found, they're going to take action against the director. Nothing can be swept under the carpet. So it's important that you understand these potential issues before you make any decisions, and a really good insolvency professional or practitioner will help you get to that stage. So we reviewed the company's financial info for any overdrawn loan accounts, any intercompany loans, any preference payments. So an overdrawn loan account, remember, is where the company is owed money by the director. An intercompany loan is where the company has lent money to another connected company that has the same directors. And a preference payment is basically where you become insolvent. You've got to be careful who you pay. If you pay off certain creditors in preference of other creditors, that could get you in serious trouble. Excuse me, I need a little bit more water. Anyway, we uncovered a director's loan of 72,000, and it wasn't in their last set of accounts because they were out of date. We did a transactional analysis with their bank statements to work out this figure. And in addition, there was a intercompany loan to a connected company of 65,000 that had happened a number of years ago. Now, the director owned a family home, he had a number of buy-to-lets, so his director's loan account was going to become a problem, and it certainly wasn't going to be written off. So what we did to help solve this problem is we put together a statement of means, basically going through all his assets, equity in all his assets, what he could afford to pay. And after some negotiation with the insolvency practitioner, it was agreed in principle that the overdrawn loan account of £72,000 would be settled at 35 pence in the pound. That equated to 25,200, and he could pay the balance over 9 months. So a hell of a result. Now, some directors don't like that advice before they're going into liquidation or administration, but my take on this is at least you're better off knowing what the problems are, because some insolvency practitioners wouldn't mention this. They get the director into administration and then be round his throat for the full 75,000 quid. What you're best off doing is uncovering this before you appoint an insolvency practitioner, because you're in the best possible chance of getting a deal done, because ultimately they want your work. Now, they can't break any rules, but if you have this conversation about an overdrawn director's loan account up front, I promise you'll be in a better position. Now, with regards to the intercompany loan, we basically had a look at the balance sheet of the company that had borrowed the money. And it was clear to see that the company couldn't afford to pay it back. It had no realisable assets. The cash flow was absolutely terrible. And on this basis, we was able to explain and give evidence why this intercompany loan couldn't be repaid back. And the decision was taken not to try and recover that loan. It was written off. Now, the director had also, we uncovered, signed some personal guarantees with Funding Circle, Capital on Tap and iWalker, okay? So we worked with a chap that we know, Gary Whitehead, AFT Assist, and Gary managed to negotiate longer payment terms with all those lenders. He didn't get any discount, but what he was able to do was, for the first 6 months, he paid minimal amounts of money off these PGs, and then after 6 months after the admin had concluded and cash flow was better, he was able to increase the amounts that he was in paying, and he's still paying them today quite successfully. Now, based on our pre-appointment work, the director was very unlikely to face any disqualification proceedings. Now, the debts of the company, just so you know, they had an overdraft with the bank had a fixed and floating charge, there was a charge from the factoring company, the HMRC was owed 700,000 quid, and other creditors were owed 1.4 million. So that's the debts. The other side were the assets of the company. They had vans and plant, and they had a ledger owed in of about 900,000 quid. Now, the deal that was done here, we got an agent to value everything, and the total to buy it all was 209,000. And what that equated to is they were offering 75 grand for goodwill. Now, this had never happened if the business had just gone into liquidation. They offered 4 grand for the tools and the office equipment. They offered 50 grand for the work in progress, and for the ledger, now bearing in mind they were owed 960 grand in, they bought it for 80 grand. So the new company was to collect in the 960,000, and out of that 960,000 they paid back 80 grand into the admin, which would be distributed to creditors. And the reason they was able to buy that money, that debtors ledger in so cheap, I'll read to you what the agent put. Should there be a cessation of trade with no continuity, then given the contractual nature of the work undertaken, the result in the erosion to the sales ledger, we understand that the majority of contracts are only 50% complete, and therefore offset charges from customers will be prevalent as they have to source alternative suppliers to complete the work. As of the date, the debtors ledger stood at 960,000. After considering the above comments from the agent, the administrator accepted an offer of 80 grand for the equitable interest in the debtor ledger, as the lack of continuity would have reduced realisations to a minimum. So if you're in construction and you just walk off site, it's highly likely that the administrator will really struggle trying to get any of the money in. There'll be retentions, or your work will be crap. Contractually, there'll be clauses in there to make it hard for the liquidator to recover the money, which means you can use that to your advantage and hopefully buy your debtors ledger. So that company was able to buy a big debtors ledger coming in as long as they carried on working, and they paid about 10p in the pound for it. So the directors was able to complete this, and they paid it over 9 months, and it saved over 80 jobs. Now today that business is flourishing, and it's back up to, it's actually up to £20 million turnover business. So out of a real bad situation, a business has grown and flourished. Now, if you have any questions about administration, if you think it might be something that your business needs to go through, my advice is speak to someone like me really quickly, okay? It's a complex process, there's lots of moving parts, it's not something to enter in on a whim. My name's Chris Word and I'm from Director First. Thanks for your time. Goodbye.